Another big batch of macro risk is out of the way, and the markets still don't care. GDP numbers out today following the Fed meeting yesterday, and still the waters do not stir. We get one little bit of macro risk left for the week, and then we'll see what the markets end up doing when that's out of the way. And of course, that is what we are going to focus on here today. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. What we are going to try to figure out here is what that market default is, because as we look at what the markets have been doing so far this week, their resilience has been really remarkable in the face of what is a very busy week of event risk. And what they reveal is seemingly an unwillingness to make any sort of a concerted effort at conviction as those outcomes have appeared. So what we're going to do here is go through and, first of all, take a look at the substance of these releases and see why it is that the markets concluded that they don't change the landscape, and then see what happens once that kind of event risk really and truly steps out of the way and traders are left to their own devices. So here's the outlook for Fed monetary policy this year and next. Note that over the course of this week, we've gotten a little bit more dovish, just a touch. But what that's ultimately done is just brought us back to where we started when the Fed delivered its latest rate change back in December. We're essentially sitting squarely in line with expectations, at least for this year. So 46 basis points on the board for 2025. The Fed's official forecast is 50. Essentially, both of these are calling for 2 cuts this year. The real question then is what happens next year. But the more important issue is that there's been a bit of an attempt to push higher. That's where the markets got all kinds of concern from mid-December that things were getting a little overheated. But then we come back and we're basically back to baseline. You can really see it when you look at the implied path for rates in Fed funds futures. Here is that very dovish view in September. Of course, since then, the markets have been on a mission to reprice for something more hawkish as the economy has shown itself to be stronger than expected. And of course, once we got the election outcome and it looked like that inflation was going to get a tailwind coming out of it, be it from deregulation and tax cuts that people were benchmarking against, or tariffs and some sort of a immigration crackdown that disrupts labor markets. All of those things comport to more inflation at face value. So we saw a repricing of expectations that already was mostly there by the beginning of November. And what we find is that the current curve, a day after the Fed's policy announcement on today's session, is barely moved from where it was in December, and indeed is clustering where that November adjustment was. So we're really not seeing a whole lot of revision here after this week's events. What were those events? Well, first, there was the Fed policy announcement. Here's the text, and thank you, Wall Street Journal and Nick Timmeros. We can see here what the changes in language were. We see that it is remarkable in its milquetoast character. It is as neutral could possibly be. The unemployment rate has stabilized and the labor market remains solid. Okay. Inflation remains somewhat elevated. Okay. In other words, not much is going on. What we find also is that in the press conference, when we have a discussion about the erasing of this text, and Powell is asked point blank whether the committee no longer believes that it's making progress toward its 2% objective, and that's why they took away that text. Powell very clearly said, actually, no, this is just new year, new statement, some wordsmithing, but that's really it. This is not a signal. And so, not surprisingly, there's not a whole lot here that moves the needle. At the press conference following the announcement, in fact, the most profound thing that Powell seemed to say was that the committee is broadly not favoring any sort of rapid move and don't think themselves as needing to change anything in any sort of a urgent way. They don't feel that they're in a hurry. And then also mentioned that he feels most of the rise in longer-term interest rates recently has been about term premium, that is to say, uncertainty about the future path of rates and the pricing in of that uncertainty as higher yields to be compensated for that uncertainty risk, than anything to do with policy. It's an interesting perspective and perhaps reflects the rise in term premium as indeed it has around the situation, of course, with rates and the reheating of the economy, as well as the new administration's policies. And to some extent, perhaps this adjustment in baseline is indeed term premium related. But nevertheless, expectations don't move much as a consequence. It is certainly the case that if we take a look at the current 10-year yield and take out the term premium and take out the break-even inflation rate, we end up at just 1.4%, which is the lowest since September. Of course, telling enough, this adjustment happens from September. And then if we take a look at the 10-year yield by itself, it's 4.5%. So needless to say, a huge component of this is inflation expectations and indeed uncertainty. We then go and see the GDP numbers. They end up being a little bit lighter than expected, 2.3% versus 2.6% expected on the annualized growth rate. And the internals here seem to be particularly interesting. This was actually the fastest month for annualized consumption growth since back here in January of 2023, the first quarter of 2023. And needless to say, that has been a major uplift here. If we consider sort of the share of each of these components in overall GDP, the latest numbers have consumption at 68.2%. So, needless to say, that's really the big deal here. It is still noteworthy, though, that for the first time, interestingly again, since the first quarter of 2023, that investment records a fall, and not a trivial one, in excess of 5%. Now, most of this you could probably chalk up to the drawing down of inventories, but if those inventories are being drawn down, well, then one thing to conclude might be that there will be more production downwind to rebuild them, and another might be that production has been slowed because there is an expectation that demand will be weaker downwind, and that's why inventories have fallen by so much. So we'll see, of course, how this develops, but the market does not find it to be uniformly negative, clearly. And so, again, Fed policy expectations are left unchanged. If we take a look at the contributions here, then we can easily see that consumption, with its rise, though in percentage terms, we can see this was a smaller rise than the fall in investment. Consumption, because of its outsized share, contributed much more to the upside in GDP than investment shaved off, though, again, this was the first such negative contribution for quite some time. This leaves us with but one piece of economic data left on the calendar, and that is the Fed's favored personal consumption expenditure measure of inflation. The expectation here is that we are going to rise on the headline to 2.6%, and that the core will remain at 2.8%, that's year on year, for the third consecutive month. Now, for the headline, this would actually be a significant increase. 2.4 was the previous number, and 2.6 would be the highest since May of 2024. So this is a meaningful increase in the headline. But as we can see, much of the rise recently has been less so about inflation going up and more so about the negative influence of energy prices in the calculation rebasing out of it. So you can see in the yellow bars here, this is the negative contribution from energy into the overall PCE winding down. And against that backdrop is where you get the headline inflation number rising, but core is much more contained. And it's because, of course, it excludes energy and excludes food in the calculation. Now, it is certainly the case that 2.8% for a third consecutive month is itself an elevated reading. The last comparable number, and frankly, the last time that inflation was higher was back in April of 2024. That was 2.9%. And when we look at the internals of how this is trending, you end up with somewhat of a mixed picture, but certainly not one that suggests, at least at face value, that the Fed ought to be in a hurry to cut rates again. So at the top here, we have the core PCE in annualized terms. In the blue bars, it's the 3-month rate. In the red, it's the 6-month rate. And then on the bottom is the actual data that we see reported. This right here is a core year on year, and the bars are month on month. Now, it is certainly the case that in November, month on month, the increase in core inflation was relatively modest. And by the way, the reason that we're looking at the core, of course, is because stripping out energy and food here makes sense. We can clearly see most of the inflation sits in core services. Core goods is barely on the menu here, and housing has been steady and looks unlikely to do much of anything until mortgage rates come down in earnest. And of course, that has to do with what the Fed does next. So the real question here really is, what will the Fed do about this right here? And that will have knock-on effects for housing. So how is this key variable moving? Well, again, the month-on-month in November certainly seems to have been an important downtick. But if we look at the trends that implies, what we find is that, helpfully at least, the 3-month annualized rate seemed to come in a bit in November relative to October. It had been rising, but the 6-month rate is holding steady at best. It is certainly not starting to recede. And what that suggests is that the medium-term kind of dynamics, when the Fed considers the incremental case for a cut, are probably not there. The trend, as it were, is not being reestablished in earnest toward more disinflation. Now, generally speaking, the market is pretty good at benchmarking these numbers because typically the CPI and the PPI numbers out of the BLS come out before this. And in them are components out of which you can construct a very close estimate of PCE. And so the markets generally don't get the forecasting terribly wrong on this. It's very rare to have a complete left field surprise on PCE. And so the numbers are probably going to come in somewhere in line with these expectations. Moreover, if we look at the way U.S. economic data has performed more generally relative to forecasts, this is an index from Citigroup here, where 0 is no surprise, above 0 is positive surprise, below 0 is negative surprise. And of course, as these things accumulate and as they move markets, you get distance. So more potent upside surprises, less potent downside surprises as the index moves. And so what you find here is that there's been a kind of reconvergence towards 0 since basically the beginning of the year, where U.S. economic data seems to be tending toward expectations, where essentially analysts' models spitting out economic forecasts seem to be, broadly speaking, well-tuned for economic reality as it then presents itself. So we end up in a situation where not only is the PCE number generally unlikely to surprise, but U.S. economic data at its current setting is generally unlikely to surprise, at least not by a significant margin. And so, once again, the bottom line seems to be that this is where we're left. Fed policy expectations anchored. The path forward basically unchanged after a week's worth of high-flying event risk with all kinds of opportunity for fireworks, but ultimately no fireworks realized. What does that mean going forward? Well, consider how the week began. We started right here with a violent gap lower, a loss of, at one point, as much as 3% for the S&P, and a generally negative day across all but the Dow Jones as far as major U.S. equity benchmarks, all that around the idea that China's DeepSeek released an AI model that looked like it could rival some U.S. offerings at much lower cost. Now, there's, of course, been a sea of ink spilled on this already, but I think the markets had the verdict from the get-go. And that, of course, was that this is not a displacing of U.S. supremacy in the space by China, or else Chinese markets would rally up a storm, and they didn't. And of course, now we're getting all of the commentary suggesting why, on technical grounds, on spending grounds, it's not exactly apples to apples, and this is not a shift in leadership, et cetera, et cetera. All of that being said, there is still another ocean of ink to spill about what all of this will ultimately mean. This is not something that's going to get decided today or tomorrow or the day after. However, what we certainly see and what we certainly know at this point is that the markets didn't like the announcement. They've gapped lower. They have not recovered. They have been idling since. And perhaps the markets didn't like it because what this announcement did was cast doubt on the trajectory that was already baked in for the AI future in all sorts of benchmark assets, be they NVIDIA or any of the other usual suspects in the AI stock universe. If your expectations were that this much money is going to get spent over this much time to build this much capacity, well, now you're not so sure about those expectations. And perhaps that's why the gut reaction from the markets here was divestment. The most curious bit for sentiment is that we have not seen relief. And perhaps the reason we've not is because we've had this macro event risk every single day this week since the DeepSeek news came out. And it's not surprising that in the midst of a large market move, when you are essentially presented with all of the top tier macro event risk you could possibly imagine. You have a Fed meeting, an ECB meeting, US and Eurozone GDP data, a Bank of Canada meeting, CPI data from Australia, just over and over and over, more and more macro risk. And none of it ultimately moves the needle. But all of it is a potential to do so. And of course, what we now then see is that Fed policy expectations are stable and they're unlikely to be dislodged. So the one thing we've learned from this week is that the markets are not going to find some sort of soothing salve from monetary policy after their tough Monday. And the markets are showing that because we've gone absolutely nowhere. And to the extent that the same sort of upshot comes out of the PCE data, one has to wonder if the default then isn't, well, we paused for macro risk. We did not want to have conviction while it was coming out. Nothing helpful came out of it. Nothing hurtful came out of it. We return to where sentiment was ex ante, before the macro risk started to spill across the wires. And that, of course, brings us back to the very same uncertainty about what DeepSeek means for the AI build-out path, and not much else. And so perhaps what this PCE report might in fact do is be more potent in its passing than its substance. Because once that event risk is out of the way, the markets are then left to whatever default they choose. And their lack of conviction over recent days perhaps gives way, of course, in the absence of any meaningful difference in the story from the macro side, where it looks like stasis in Fed policy bets is undefeated. We just come back to where the story was before. And that makes for a rocky end to this volatile and ultimately more confusing than anything kind of week. That is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things may go therefrom. Back with Chris for Futures Power Hour, Mondays and Fridays. That's where I'll be tomorrow. I'm on with Victor Jones for The Price of Truth on Tuesdays. Back with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter, as well as now on Blue Sky as well. If you're watching on YouTube, like and subscribe. Macro Money's back next week. Happy trading.